In 2021, Jake quit his job to trade full-time. Within 8 months, he'd paid off $42K in debt, bought his dream car, and told his boss he'd never work for anyone again. By the end of year 2, he was living in his parents' basement, avoiding calls from creditors, and telling people he was quote-unquote between jobs. Same market, same person, 2 completely different endings. Full-time trading has this intoxicating promise, freedom, control, unlimited income, no boss breathing down your neck, no corporate ladder to climb, just you, your skill, and the market. But here's the part no one tells you. The same mental and emotional forces that can turn you into a high-performing trader can just as easily pull you into a downward spiral faster than you think. Today, we're pulling the curtain back on both sides of the story. How full-time trading can save your life, give you purpose, freedom, and financial power, and how it can destroy it through isolation, burnout, and the slow erosion of your mental capital. Because the difference between the two isn't the market, it's you. For every trader who dreams of going full-time, there's a single moment burned into their mind the day they walk away from their job. No more answering emails you don't care about. No more watching the clock. Just pure freedom and the belief that from now on, your income will be limited only by your skill and discipline. It's the same dream that pushed Jake to hand in his resignation letter. It's what made Maria, a single mother of 2, leave her corporate role to trade from home. And for a while, both of them lived the dream. But here's the problem nobody talks about. Going full-time doesn't just magnify your opportunities. It magnifies your weaknesses. When you trade part-time, your losses are buffered by a paycheck. Your wins feel like a bonus. You can step away without financial panic. Go full-time, and every decision becomes heavier. Every losing day feels personal. Every win feels like survival. And the line between disciplined execution and emotional chaos gets razor thin. In this video, we're going deep into the truth that most traders never hear until it's too late. You'll see the 5 psychological advantages that full-time trading can give you and the 5 mental traps that can destroy you if you're not ready. We'll break down the neuroscience behind discipline collapse, the hidden identity shifts that come when trading becomes your only income, and the subtle mental bankroll leaks that can drain you long before your account ever blows up. By the end, you'll know exactly whether you are mentally equipped for the jump to full-time or if you're about to walk into a trap you can't see yet. Question for you. If you had to go full-time trading starting tomorrow, what's the single biggest fear you'd have? Drop it in the comments because we're going to address them head on. Chapter 1. The Liberation Effect. How full-time trading rewires your sense of freedom. When Daniel walked out of his office for the last time, he swore the air smelled different, lighter, as if the whole world had shifted from grayscale to color. It wasn't the money that lit him up, it was agency. From now on, no one could tell him when to show up, when to eat lunch, or how much his time was worth. Psychologists call this the liberation effect, the mental and emotional release that comes when you strip away external control over your daily life. And it's powerful. Neuroscience shows that perceived autonomy is one of the strongest drivers of human motivation. Studies on self-determination theory reveal that people who feel in control of their work not only perform up to 40% better, but also experience lower stress hormone levels. Freedom feels like safety, and safety unlocks possibility. For Daniel, this translated into sharp focus and calm execution. His first 2 months as a full-time trader were his most profitable ever. He held trades longer, managed risk more precisely, and operated with a clarity he hadn't felt in years. But freedom is a double-edged sword. At his job, Daniel had structured deadlines, schedules, accountability. Without it, he was free, but also floating. By month 4, he was sleeping in, scrolling charts in bed, and taking trades outside his plan just to see. The same autonomy that had fueled him was now eroding him. His edge wasn't gone, but his discipline was slipping away. This isn't laziness, it's neuroscience again. The brain craves novelty. Once the thrill of being your own boss wears off, dopamine levels fall. Without external pressure, you're forced to generate your own motivation, and most people aren't trained for that. It's why entrepreneurs and traders alike often hit a slump within 6 months of going full-time. Maria avoided that slump. A former accountant, she transitioned into full-time trading only after proving consistency for 2 years part-time. Her secret wasn't talent, it was structure. She set start and end times even when she didn't need to. She ran through a pre-market checklist before placing a single order. She debriefed every session, no exceptions. Freedom didn't dissolve her discipline, it amplified it. Her first year closed up 38%, and more importantly, she stayed steady. Leon's story ran the other way. After 3 years of profitable side trading, he quit his job with $60K in savings. Month 1 plus $8,000. Month 2 plus $6,500. But the routine that had once kept him sharp began to unravel. He started sleeping late, skipping his journal, adding trades for fun. By month 8, his account was down to $19K. It wasn't his strategy that failed him. It was freedom unmanaged. This is the paradox of trading full-time. Your mental state becomes your business model. If you can maintain structure, freedom becomes fuel. If you can't, freedom becomes friction. Ego depletion makes self-control fade as the day drags on. Temporal discounting tricks you into choosing short-term comfort over long-term discipline. In a job, guardrails protect you from both. In trading, you have to build your own. The answer isn't to give up freedom, but to channel it. The traders who last are the ones who create external accountability, time block their days, and physically separate their workspace from their living space. They treat routines as contracts, deadlines as non-negotiable, and reviews as sacred. They catch freedom drift early before habits erode into chaos. And they ask themselves at the end of every day, did I trade like a professional or like an amateur drunk on autonomy? Because in the end, the liberation fact is real, but it only works if you can balance freedom with discipline. Without structure, freedom unravels you. With it, freedom unlocks your best self. And if you've ever felt both empowered and overwhelmed by the independence trading gives you, know this. The next hidden cost isn't just freedom, it's isolation. And that too can either sharpen you or quietly break you. Chapter 2, The Isolation Spiral, How Full-Time Trading Can Quietly Erase Your Support Systems. When Sam left his job to trade full-time, he thought the best part would be the solitude. No commuting, no office politics, no forced small talk. Just him, his screens, and silence. And for the first few weeks, it was bliss. But slowly, something shifted. He began ignoring calls from old colleagues, letting family text threads sit unanswered for days, and even avoiding something as simple as a trip to the grocery store. He didn't recognize it yet, but he was already sliding into the isolation spiral, a slow, quiet withdrawal from the very connections that once kept his mind balanced. Most traders focus on financial risk when they go full-time, drawdowns, lack of a paycheck, market volatility, but one of the most dangerous threats isn't on the chart, it's in the environment. Chronic isolation corrodes psychology. When you spend most of your waking hours alone, the brain's social reward systems weaken. Stress lingers longer, emotions hit harder, and regulation becomes more difficult. Research shows that the health consequences of long-term isolation rival smoking a pack of cigarettes a day. For a trader, the damage shows up faster, not in the body, but in decision-making. Angela's story shows the slide. A former nurse, she loved the peace of trading at home. No alarms, no chaos, no endless hospital politics. But after 6 months, she found herself talking to her screens and refreshing Twitter just to feel like someone was listening. The more she isolated, the more emotional her trading became. Drawdowns deepened, not because her system broke, but because her psychology did. Greg, on the other hand, took a different path. When he quit his job, he joined an online trading community with live voice chat. He built 2 social rituals into his week, a local running club and volunteering at a food bank. It wasn't networking. It wasn't optimization. It was survival. 5 years later, Greg is still trading profitably, and he credits as much of his longevity to those connections as to his risk management. The neuroscience explains why. Human brains are wired for connection. Social contact triggers oxytocin, which lowers cortisol and restores emotional balance. Without it, till setting faster, patience thins, and every tick of PL feels like a personal verdict. In isolation, bad ideas echo unchecked. Social media replaces real connection, and the natural rhythm that balances stress disappears. What starts as freedom turns into a cage, and the worst part is how quietly it happens. The solution isn't complicated, but it is deliberate. Traders who last schedule their social contact the same way they schedule their trades. They seek out peers who can challenge and support them, but they also keep relationships that have nothing to do with markets. They design identities outside of trading sports, hobbies, creative pursuits, so their entire sense of worth isn't tied to the next day's PL. They check in with themselves weekly, asking a deceptively simple question. How many real conversations did I have this week? If the answer is too low, they know it's time to course correct. Because in the end, trading is lonely only if you let it be. Isolation can warp your psychology and drain your edge, but connection, real, intentional connection, can protect it. And if you've ever underestimated the cost of trading alone, know this. The next hidden danger isn't isolation at all, but the invisible mindset shift that happens when you stop earning a paycheck and start living off your P. That shift, if unmanaged, can quietly wreck new full-time traders even faster than solitude. Chapter 3. The Paycheck to P and L Shock. Why income volatility breaks even skilled traders. When you work a regular job, you can be distracted on Tuesday, mediocre on Wednesday, and still get the same paycheck on Friday. Trading doesn't work that way. When you step into it full-time, you're replacing the stability of a fixed paycheck with a completely variable income stream. And that shift from steady to unpredictable is one of the hardest psychological transitions a trader will ever face. Jake found out the hard way. He left engineering with $80K in savings and 2 years of consistent part-time profits. His first 2 months as a full-time trader looked like proof he'd made the right move, plus $7,200, then plus $6,800. But month 3 was minus $4,500. And by month 4, the losses weren't the real problem. It was the stress of wondering how to pay rent. He wasn't just trading the market anymore. He was trading for survival. The brain is wired to crave predictability, especially when it comes to money. Inconsistent earnings trigger elevated cortisol responses, impairing working memory and skewing risk assessment. It's the same mechanism casinos use to hook gamblers. Variable rewards create bigger emotional swings than predictable ones. For traders, that means income volatility doesn't just stress you, it actively makes you more likely to trade poorly. Part of why the shift feels so violent is rhythm. A paycheck creates emotional rhythm. Money arrives on schedule, bills get paid without surprises, and the future feels forecastable. Remove that rhythm, and your nervous system goes into resource uncertainty mode. Instead of long-term planning, the brain fixates on short-term survival. In the market, that shows up as forced setups, cutting winners early or refusing to step away even when discipline is slipping. Some traders, like Sophia, build their own rhythm. She treated trading like a business from day one, channeling all profits into a separate account and paying herself a fixed monthly salary. Surpluses stayed in the business to cushion slow months. This not only kept her lifestyle stable, it gave her permission to think in quarters instead of days, reducing the emotional pressure of single losing weeks. Ben, on the other hand, made the opposite move. Flush from early profits, he upgraded his apartment, bought a new car, and started treating trading gains like a personal ATM. When 3 losing months hit in a row, his lifestyle cost became a noose. Instead of cutting expenses, he tried to trade his way back, doubling size and forcing setups until both his account and confidence bled out. He didn't go broke from bad trades. He went broke from bad income management. The hidden dangers of the paycheck to PL shift aren't just financial, they're psychological. Every month becomes a verdict instead of part of a long-term curve. Lifestyle inflation traps you into needing bigger wins to sustain unnecessary costs, and the pressure of bills breathing down your neck tempts you into setups you'd never touch otherwise. loss aversion amplifies every drawdown, and myopic risk perception shrinks your time horizon until you can only see the next day, or worse, the next trade. The traders who survive don't eliminate volatility, they build systems to absorb it. They pay themselves a fixed salary even if their profits are uneven. They keep 6 to 12 months of living expenses outside of trading capital. They think in 90-day cycles instead of weeks. They separate personal life from trading accounts, automate their bills, and plan for dry seasons instead of pretending every month will be green. Above all, they reward consistency and discipline, not just profit. The question isn't whether you can handle a bad trade, it's whether your lifestyle can survive 3 bad months in a row without breaking. If the answer is no, then the work isn't only in your charts, it's in your structure. Because trading for a living isn't just about winning trades, it's about creating stability in an unstable game. And even for those who manage the money side, there's another danger waiting, the one that takes down even profitable traders: burnout. Because once the financial pressure is handled, the next silent killer isn't volatility at all, it's exhaustion. Chapter 4: The Burnout Loop. How full-time traders work themselves out of the game. Most traders think the biggest threat to their career is losing money, but the truth is more subtle. The real killer is burnout, and it rarely arrives with a single dramatic blow. It seeps in slowly, disguised as exhaustion, detachment, or a nagging sense that nothing you do is enough. At first, you just feel drained. Then you notice you're forcing trades just to feel like you're working, or worse, avoiding the screens altogether because you can't face them. Setups you once loved don't spark the same interest, and skills you've already proven suddenly feel doubtful. The risk multiplies when you go full-time. In a regular job, you have days off, built-in breaks, vacation time, even managers who notice when you're slipping. Trading offers none of that. You are your own worker, your own manager, and your own HR department. Without those external guardrails, most traders push harder than ever before, not because they're more disciplined, but because they feel guilty if they aren't grinding. That guilt drives overcommitment. And overcommitment is the first step into the burnout loop. Priya, who left corporate finance to trade full-time, believed that more screen time meant more opportunity. She went from London's pre-open to New York's close and even peaked at Asia's session before bed. Her first signs of burnout weren't even on the charts, they were in her body. Headaches, sleepless nights, irritability. By month 6, her edge wasn't gone, but her ability to execute was. Fatigue had rewired her judgment. Mark's story looked different, but the pattern was the same. After his best quarter ever up 42%, he thought momentum would carry him further if he just pushed harder. By the third quarter, he wasn't losing money, but he was losing himself. Wins felt flat, losses cut deeper, and everything in between felt gray. It wasn't until he forced himself to step away that he realized how far into the burnout spiral he had drifted. That spiral always follows the same cycle. You overcommit, you sacrifice recovery, your performance dips. You try to trade harder to compensate, which accelerates the collapse. Eventually, you either blow up financially or withdraw mentally. Neuroscience explains why. Chronic exposure to market stress keeps cortisol levels elevated, and high cortisol impairs the parts of the brain responsible for memory and decision-making. In trading terms, that means worse pattern recognition, slower reactions, and less tolerance for drawdowns. High performers are even more at risk because they push themselves the hardest and are slowest to admit when they need rest. The only way out is to recognize that recovery isn't optional, it's part of the edge. Fixed trading hours protect you from drifting into endless screen time. Scheduling recovery with the same seriousness as a trade keeps your energy reserves intact. Taking deliberate breaks after big wins or big losses prevents momentum from turning into mania. Rotating between high-intensity weeks and capital preservation weeks ensures you don't burn the candle at both ends. And perhaps most importantly, measuring energy instead of hours forces you to face the truth. If you start the day empty, no amount of discipline will save your execution. The smartest traders even create an early warning checklist for themselves. Am I skipping workouts? Am I impatient with trades? Do I dread opening my charts? If 2 or more answers are yes, the only right move is rest. Burnout doesn't announce itself with flashing lights. It creeps in, and by the time you feel it, you've already given back clarity, patience, and confidence. The real test isn't whether you can push harder, it's whether you can step back before the loop takes you under. Ask yourself this: if you were forced to take a full week off starting tomorrow, would your trading improve or decline in the month that follows? Your answer will tell you if you're on the edge of burnout or already inside it. Chapter 5: Identity Lock. When trading becomes who you are instead of what you do. When Brandon went full-time, he thought he was chasing freedom. No boss, no time clock, no ceiling on his income. But within a year, he realized he was chasing something else entirely: validation. He wasn't just trading anymore, he was becoming a trader. It was in his Instagram bio, in the way he introduced himself at family gatherings, even in the way he described himself on dating apps. And that's when the problem started. Because once your entire sense of self is fused to your performance, a losing week isn't just a bad week, it's a threat to who you are. This trap is called identity lock, and it happens when the role you play hardens into your core sense of self. In some domains, it can be useful. Athletes use it to push through pain. Entrepreneurs use it to stay the course. But in trading, it can be devastating, because losing streaks are inevitable. When they arrive, you don't just doubt your method, you doubt your worth. Melissa found this out the hard way. She branded herself online as the 9-to-5 dropout, celebrating her early wins and building a following. But when a 3-month drawdown hit, she felt trapped. She couldn't bring herself to admit the losses publicly, and instead of scaling down or adapting, she forced trades to protect the brand she had built. 4 months later, her account was down nearly half. Looking back, she admitted it wasn't the money that destroyed her. It was the need to keep the image alive. David's story looked quieter but carried the same weight. He wasn't posting on social media, but in his family, he was the trader. When things were going well, every holiday came with proud questions. How's the market? What's your next big play? But when he hit his first real slump, he started skipping gatherings entirely. He couldn't face the thought of saying, "I'm struggling." His identity had been hijacked, and that fusion of self-worth with PL left him isolated when he most needed support. Neuroscience explains why this hit so hard. Identity lives in the same region of the brain that regulates emotion. When that self-concept becomes too rigid, every losing streak is processed as a threat to survival. Cortisol floods your system, your decision-making narrows, and trading turns erratic. Losses start threatening identity, stress spikes, execution breaks down, and those mistakes feed even deeper into the identity threat. It's a vicious loop, and the deeper you go, the harder it becomes to separate yourself from the results. You get trapped by the pressure of public commitments, protecting your image at the expense of protecting your capital, and clinging to the same strategies because changing them feels like betraying who you are. Breaking out means rethinking who you are outside the charts. The traders who survive this build bigger identities. They're not just traders, they're also parents, runners, musicians, volunteers, learners. They anchor their self-worth not in whether they had a green week, but in whether they followed their plan with discipline, whether they adapted intelligently when markets changed. They don't plaster every result online, especially early in their journey, because they know every public declaration becomes a shackle when conditions turn. They write down clear conditions for when they'll adjust their strategy or even step back, so adaptation feels like strength instead of defeat. They surround themselves with people who value them for more than their PL, and they check in with themselves, asking, if my results disappeared tomorrow, who would I still be? Because the truth is, markets will test you. They will strip away comfort and expose every crack. If your entire identity rests on being a trader, the losses will cut into your sense of self as much as your account. But if you build a bigger base, if you see yourself as someone who executes with discipline, adapts when needed, and is more than the numbers, you stay free. The market can take money, but it can't take you. Chapter 6: The Skill Plateau. Why full-time traders stop improving and how to break through. When Emma first stepped into full-time trading, her growth curve was electric. More screen time meant more discoveries. She spotted patterns quicker, her execution grew sharper, and risk management started to feel almost instinctive. By the end of her first year, she could look back and see tangible progress in every part of her craft. But by her third year, something strange happened. Her results stopped improving. She wasn't losing, but she wasn't evolving either. It was as if she'd hit an invisible ceiling. That ceiling has a name, the skill plateau, a trap that catches even disciplined traders when they confuse activity with progress. The early stages of trading are intoxicating because every session feels like new territory. You're refining entries, adjusting exits, and every mistake feels like a step forward. But once you reach consistent profitability, the game changes. Execution becomes smoother, almost automatic. Psychologists call this state automaticity, where tasks are carried out with little conscious effort. It feels efficient, but it quietly kills growth. A trader who stops engaging with mistakes, who stops stretching beyond their comfort zone, unknowingly trades in curiosity for routine, and in markets that are always shifting. Routine is a dangerous resting place. Liam fell right into that trap. He had a strong strategy in S&P futures and rode it successfully for 2 years. But when volatility shifted, his edge began to thin. Instead of testing adjustments, he convinced himself that more screen time would fix it. More trades, more hours, more effort. But all he got was more of the same results. Emma, on the other hand, eventually realized she had stalled. Instead of doubling down on what was familiar, she forced herself into deliberate practice. She set aside a full day each week just for review, joined a small group of peers to critique her charts, and made herself backtest at least one new variation every month. Within 6 months, her win rate climbed again, and just as important, she felt engaged with the process, not just mechanically executing it. Then there was Carlos, a forex trader who had been profitable for 4 years but flatlined at the same performance level. At his mentor's suggestion, he began studying crude oil futures, not to change careers, but to retrain his eye. Oil moved differently, its volatility rhythm unique, and forcing himself to adapt sharpened skills that had dulled from repetition. When he returned to forex, his execution carried a new fluidity. What looked like stagnation before was suddenly movement again. Neuroscience explains why this happens. The brain thrives on novelty when building skills. Every time you push just beyond what you know, new neural pathways form. But when trading becomes too familiar, your brain stops stretching. Improvement halts not because you are incapable, but because your environment no longer demands it. The plateau is the natural consequence of comfort. And in trading, comfort quietly erodes your edge because the market is never still, even if you are. Breaking through means deliberately manufacturing discomfort. It means carving out time not just to trade, but to learn. It means testing setups in markets you've never touched, reviewing losing trades until the patterns behind them scream at you, and inviting critique from traders who see what you can't. It means rotating your focus so you're not just repeating the same execution, but drilling different elements. Entries 1 month, management the next, and exits after that. True growth doesn't come from more hours in front of screens. It comes from structured effort, aimed at what feels awkward but exciting. The plateau develops in stages. First comes the rapid growth of early learning, then stabilization as you find consistency. Comfort follows what once demanded, focus now runs on autopilot. And when markets inevitably shift, if you're still clinging to the same habits, stagnation sets in. It feels safe, but in truth, it's the beginning of decline. The only way out is to treat adaptation as part of your identity, not a side project, not an emergency fix, but the very definition of being a professional. Emma broke her plateau the moment she stopped asking, "How can I trade more?" and started asking, "How can I learn more?" That simple shift reignited her growth curve. If you've been working harder but standing still, chances are you're already on the plateau. The real question is, when was the last time trading made you uncomfortable in a way that excited you? If you can't remember, you're not pushing far enough, because comfort might feel safe in the moment, but in markets, it's the most dangerous place to live. Chapter 7. the lifestyle mismatch. When trading success doesn't equal life satisfaction. When Mia pictured life as a full-time trader, she imagined slow mornings, midday workouts, maybe even more travel than her old 9-to-5 could ever allow. But the reality looked nothing like that. Instead of freedom, she found herself waking at 5:30 a.m., chained to her screens until early afternoon, and spending evenings buried in backtests and chart reviews. Her account was growing, but her life felt like it was shrinking. She hadn't run into a trading problem, she ran into a lifestyle mismatch. Most traders believe that once profitability is secured, everything else will fall into place. But the truth is harsher. Profitability only magnifies the structure you've built. And if that structure doesn't fit your values, no amount of money will make it satisfying. Ravi learned that the hard way. He left corporate law to find freedom in the markets. But the European indices he chose demanded he work at 2 a.m. local time. He told himself it was temporary, but 5 years later his sleep was wrecked, his social life was non-existent, and he admitted he had less freedom now than when he was a lawyer. Then there was Tara, who was pulling 5-figure months trading US equities, but realized she hadn't taken a single vacation in 3 years. The profits weren't the problem the constant tether to the screen was. She wasn't building freedom. She was building a prison made of green numbers. Psychology explains why this hurts so much. Humans crave congruence between what they value and how they live. When your actions consistently conflict with your values, your brain experiences it as low-grade stress that compounds over time. Studies have shown that high income without lifestyle alignment actually produces less satisfaction than moderate income with high alignment. That's the paradox many traders discover. The money is there, but the fulfillment isn't. Chris discovered this when trading crypto full-time. The 24/7 markets gave him action at every hour, and at first he loved it. But within 18 months, he was exhausted, burned out, and detached from anything that wasn't trading. His fix wasn't another strategy or more hours, it was redesigning his entire structure. He switched to swing trading, imposed hard limits on screen time, and blocked weekends off completely. His profits dipped slightly, but the trade-off was worth it. He described it as getting my soul back. That's the thing about trading. It doesn't just test your technical edge, it tests the life you've built around it. The brain is always running an internal audit, measuring your daily reality against your expectations. When that gap grows, dopamine drops, motivation wanes, and even green months feel gray. Lifestyle mismatch doesn't hit all at once, it creeps. First, you're just working hard to make it. Then you're working hard to keep it. And before you know it, you've built a business that pays you well but feels suffocating to live inside of. The only way out is to design your trading around your life, not the other way around. That means setting boundaries as deliberately as you set stops. It means choosing markets that align with your energy and sleep, not just your profit potential. It means building in real-time off days, with no charts, no alerts, no pretending you're resting while secretly checking price feeds. And it means checking in with yourself regularly. If your trading profits doubled tomorrow but your daily life stayed exactly the same, would you be happy? If the answer is no, the redesign can't wait for someday. Because money can give you options, but only structure aligned with your values can give you freedom. And that's the real lesson of lifestyle mismatch. Trading can absolutely give you the life you want. But if you don't stay vigilant, it will just as easily trap you in one you never meant to build. Chapter 8. The Confidence Crash. Why big wins can break full-time traders. Most traders expect their confidence to take a hit after a bad loss. What they don't expect is for it to collapse after a big win. It sounds impossible, even absurd, but it happens more often than you think. Sophie learned this in May of her second year full-time, when she landed her biggest trade ever, a single swing position that brought in $48,000. She thought it would feel like she had finally arrived. Instead, it felt like a wait. Every trade that followed seemed small, almost pointless by comparison. She hesitated to take her usual setups, thinking, why bother if it's not another 48K? Within 3 months, her trading volume had dropped by more than half, and her once sharp edge began to dull. Mark went through something similar after winning a high-profile trading competition. The recognition was exhilarating, but it also planted a seed of doubt. Every month that followed became a quiet test. Am I still that guy? Instead of following his proven process, he tried to outdo his own record. The harder he pushed, the more he forced trades, and for the first time in 2 years, he finished a quarter in the red. This is the strange psychology of the confidence crash. It isn't really about money, it's about recalibrated expectations. When you hit a huge win, your brain floods with dopamine, but the brain adapts quickly, and what felt extraordinary becomes the new standard. Suddenly, normal wins feel dull. Traders either chase bigger risks to recapture the high, or they withdraw paralyzed by the thought of falling short. David, for example, made 120K in a single month during the meme stock surge. Instead of building on it, he froze. For nearly 2 months, he didn't take a single trade. He wasn't celebrating. He was terrified of giving it back. The win had shifted him from playing to win to playing not to lose. Neuroscience explains the crash. When outcomes greatly exceed expectations, dopamine neurons fire in a way that resets your baseline. The spike is intoxicating, but the drop is just as steep. What once felt exciting suddenly feels underwhelming, and that creates a dangerous loop. You either disengage from the game or you push recklessly to recreate the peak. Both paths erode confidence. But not every trader falls into the trap. Carla, a futures trader who broke her personal record twice in a single year, built a ritual for herself to prevent it. After each career best win, she closed her screens for the rest of the week, reviewed her journal to anchor her confidence in process rather than profit, and deliberately traded smaller size for the following 2 weeks. She called it her reset protocol, and it allowed her to normalize quickly. Instead of letting the high water mark control her, she reframed it as an outlier and returned to her baseline with her edge intact. The real danger of a big win is that it can warp your identity. It whispers that you are now a different kind of trader, one who must prove you deserve the number you just posted. But the truth is that a single outlier doesn't define you. What defines you is what you do afterward, whether you chase it, hide from it, or reset and return to your craft. The biggest win of your career should be a milestone, not a prison. So ask yourself, if your biggest trade ever happened tomorrow, what would you do in the 2 weeks that followed? Because how you handle that answer might matter even more than the win itself. Chapter 9. The Relationship Tax. How full-time trading reshapes your connections. When Jason went full-time, he imagined his relationships would only get stronger. More time at home, less stress from office politics, and the freedom to shape his own schedule. What could go wrong? But 6 months in, his girlfriend sat him down and admitted she felt like she was competing with the market for his attention. That's the invisible tax of trading full-time. It doesn't just change your bank account, it changes how you show up for the people around you. Even when you are physically present, a part of your mind stays glued to the charts. You start paying with attention, patience, and emotional presence, and the people closest to you feel it long before you do. Maya learned this the hard way. Her husband noticed she was constantly on her phone during dinner. She wasn't scrolling Instagram, she was checking alerts, monitoring setups, and sneaking peeks at market news. She swore she could multitask, but he felt her slipping away. It wasn't about the minutes she spent, it was about the mental bandwidth trading consumed. The psychology behind it is simple but brutal. Relationships require emotional presence, the ability to tune into another person fully and co-regulate with their cues. But when one mental foot is always in the market, that presence erodes. Even minor distractions reduce perceived empathy. And over time, partners or friends start to feel like they're talking to a ghost version of you. Tom's story shows how this plays out socially. In his early 30s, single and thriving, he assumed trading would give him even more flexibility to connect with friends. Instead, it pushed him out of sync. His peak hours overlapped with their free time. He skipped pickup basketball games, missed birthdays, and slowly became the guy who's always busy. His circle shrank not because he'd chosen isolation, but because his life rhythm no longer matched theirs. And the feedback loop doesn't stop at your relationships. When your support system weakens, trading performance often slips with it. Stress builds, perspective narrows. The market starts to feel bigger than it is because you've lost the outside grounding that helps put wins and losses in context. Anna faced this exact problem in her marriage. Instead of ignoring it, she and her spouse made a simple rule. From 6 to 9 a.m., the markets didn't exist. No trades, not even casual mentions. They also carved out one full weekend each month completely free of charts. It wasn't just a relationship reset, it gave her mind the space to recharge. And when she returned to trading on Monday, she found her focus sharper than before. Science backs it up. Oxytocin, the bonding hormone, is released during quality interactions, but stress from constant volatility suppresses it, making it harder to feel connected even when you're sitting across from someone you love. Chronic partial tension, the habit of splitting focus between people and screens, keeps your brain in a low-grade stress state, which erodes patience and empathy over time. Raphael experienced this most intensely in a long-distance relationship. At first, he thought his flexibility as a trader would make the distance easier. Instead, he filled every available moment with market activity. His partner felt increasingly sidelined. The fix wasn't dramatic, but it was deliberate. Structured calls twice a week, voice notes exchanged only during non-market hours. It didn't solve everything, but it rebuilt trust by showing that he could still prioritize connection. This is the hidden tax no one warns you about. You think going full-time will give you more time for the people you love. And in one sense, it does. But unless you consciously manage your energy and attention, trading will eat the very presence those people actually want from you. So here's the question. If your closest relationships were a portfolio, would they be trending up, flat, or down since you went full-time? And if the answer makes you uncomfortable, what's the one adjustment you can make this week to change that trajectory? Chapter 10. The Adaptation Gap. Why Traders Fail When the Market Evolves Faster Than They Do. When Victor started trading full-time in 2019, it felt like nothing could stop him. His breakout strategy on tech stocks printed money in every condition he touched, and by the end of the year, he was up nearly 300%. But by mid-2020, he was broke. What happened wasn't that he suddenly forgot how to trade. It was that the market changed faster than he did. That's the brutal truth about markets. They're living systems. They shift with macro trends, liquidity flows, regulations, and the crowd's collective behavior. The adaptation gap is the space between when the market evolves and when your process catches up. If that gap is small, you lose a few weeks. If it's big, it can end careers. Dana learned this the hard way. In 2017, her scalping strategy thrived in low volatility conditions. Then late 2018 hit, spreads widened, price swings grew erratic, and her safe stops suddenly weren't safe anymore. She told herself it was temporary, that things would settle back down, but the longer she rationalized, the deeper the hole became. By the time she admitted the market has structurally shifted, she'd given back 2 years of gains. The same story played out during the pandemic crash. Some traders adapted in weeks, switching to shorter holding times, tighter stops, and high volatility plays. Others clung to their old setups, waiting for normal to return. Many of them never made it past summer. The psychology behind this delay is well documented. Humans cling to what's familiar, even when it's no longer effective, a bias known as the status quo effect. Adding the sunk cost fallacy, the tendency to overvalue time and effort already spent mastering an approach, and you get traders who defend broken strategies long after the data has clearly moved on. A 2015 MIT study found that people routinely delay abandoning failing methods simply because the brain values past investment over future opportunity. In trading, that lag is often fatal. The adaptation curve always follows the same arc. First comes the observation phase, something feels off. Then the rationalization, telling yourself it's just temporary. Eventually, recognition sets in. The market has changed. If you push through, you enter experimentation, testing new parameters, trying new setups. Finally, if you survive long enough, you integrate those changes into your process. The danger lies in the second phase. The longer you rationalize, the wider your gap grows, and the more damage you take. Alina saw this firsthand during the crypto boom. In 2021, she was crushing it, but when the market cooled, she pivoted quickly, shifting to range trading, then shorting when the setups made sense. Her peers, who waited for the bull run to come back, saw their equity curves collapse. Hers stayed intact because she accepted reality faster than they did. Adaptability isn't just a personality trait, it's neurological. The anterior cingulate cortex, the part of the brain that monitors errors and shifting environments, plays a central role. Traders who actively seek novelty and feedback keep this system sharp, making pivots easier. But those who avoid discomfort let that responsiveness dull. In practice, that means one group tests, tweaks, and survives, while the other rationalizes until it's too late. Lewis understood this better than most. He had a simple rule: never go more than 2 weeks without making a micro adjustment. Sometimes it was as small as tweaking an EMA setting, other times it meant filtering out trades on news-heavy days. These constant incremental adaptations kept him aligned with the market's rhythm. While others faced sudden overhauls, Lewis never let the gap widen enough to become dangerous. So the question isn't whether markets will change. They always do. The real question is how quickly you can change with them. If your current strategy stopped working tomorrow, how long would it take you to adapt days, weeks, months? Whatever your answer is, that's your vulnerability. Because in the end, the market doesn't reward the strongest or even the smartest. It rewards the most adaptable. Chapter 11, The Independence Illusion. Why being your own boss still feels like a job. When Alex quit his corporate job to trade full-time, it felt like freedom. No more morning commute, no more performance reviews, no more middle managers breathing down his neck. For the first few months, it was bliss. But slowly, a realization crept in. He hadn't actually escaped having a boss. He had simply swapped one for another, the market. That's the myth of total freedom in trading. On paper, you decide when to work, how to work, and how much to earn. In practice, market hours, volatility cycles, and the demands of your own edge become the new clock, the new manager, the new quarterly report. Sophia learned this when she imagined her mornings would finally belong to her, only to find herself waking earlier than ever to catch pre-market moves. Vacations were supposed to be spontaneous, yet she caught herself scheduling every trip around FOMC meetings and earnings seasons. She wasn't unhappy, but she realized she was still serving a master just one without a corporate title. Psychologists call this dynamic the illusion of autonomy. Humans thrive on the sense of choice. But autonomy isn't about what you do. It's about whether your actions align with what you truly value. A 2014 study in motivation and emotion found that people with high control over their schedules but little alignment with their personal values reported no increase in life satisfaction at all. Freedom without alignment feels like another job in disguise. Derek learned that lesson the hard way. He loved the idea of being location independent, but his Forex edge required late-night sessions. Within a year, his sleep was wrecked, his social life was gone, and he realized he was effectively on call 24/7, just like in his old IT job. The cycle usually looks the same. First comes the rush of freedom, that intoxicating feeling that you've broken out of the cage. Then routine creeps back in your edge, starts dictating your schedule. Soon, you realize that your choices are still shaped by external forces. And that's when you hit the fork. You either adapt your expectations or grow frustrated with the very thing you thought would set you free. Lena chose the first path. She decided she'd rather make a little less money than let trading consume her entire day. By switching to swing trading, she cut her daily screen time from 6 hours to 2. Her PL dipped slightly, but she got her mornings back, her workouts back, her weekends back. For her, that was real freedom. Neuroscience backs this up. The brain's ventral striatum lights up when we perceive choice. But if those choices exist only within tight constraints, the motivational boost evaporates quickly. That's why some traders feel just as trapped in full-time trading as they did in corporate life. Their real autonomy is still limited, only now by market structure instead of a boss. Omar found his own solution by leaning into seasonality. Every summer, he grew restless, chained to his desk while life outside was buzzing. So he redesigned his year. From October to May, he traded aggressively. From June through August, he cut his size, trimmed his hours, and reclaimed his summers. His annual profits stayed steady, but his enjoyment of life soared. That's the real challenge of full-time trading. It forces you to confront what freedom actually means to you. Is it money? Is it time? Is it flexibility? If you could redesign your trading so that it served your life instead of the other way around, what would change first, your schedule, your style, or your markets? Because until you answer that, independence will always feel like an illusion. Chapter 12. The Legacy Problem. Why P&L alone won't satisfy you long-term. When Rachel hit her first million in trading profits, she expected to feel unshakable pride. Years of sacrifice, missed weddings, weekends buried in screens. The endless grind had finally paid off. But instead of satisfaction, she felt empty. She'd built her entire identity around the climb, and now that she was at the top, a question echoed louder than the applause in her own head. What was it all for? This is the hidden void behind the numbers. Most traders think the end game is obvious: make money, achieve freedom, repeat. But money is a finite motivator. Once your lifestyle is secured, once you can pay the bills, travel when you want, and live without financial stress, its ability to deliver fulfillment diminishes. Psychologists call this the goal gradient effect. Motivation peaks when a goal is within reach, then drops sharply once it's been achieved. Kyle learned that lesson when he reached financial independence at 37. He imagined slowing down, spending more time with family, traveling, maybe even mentoring new traders. But instead of stepping back, he kept trading harder, chasing bigger numbers without knowing why. 2 years later, he burned out not because of losses, but because he had no reason beyond the money to keep going. Humans are wired for meaning-making. We want to know that our actions matter, that they leave a mark beyond ourselves. A 2020 Harvard Business Review study found that high-income individuals with low perceived purpose reported the same happiness levels as those earning average income. Without a why, the how much eventually loses its power. Elena, a veteran with 15 years in the markets, discovered this when she began coaching younger traders. She still traded her own account, but she found more joy in watching others succeed than in adding another 5-figure months to her ledger. Her PL didn't change dramatically, but her sense of contribution did. That's the legacy problem in trading. The game is individualistic by design, and if you're not careful, you can spend decades building nothing that exists outside your own bank account. For some, this creates a fulfillment gap. Financial success racing ahead of emotional satisfaction. Marcus solved it by setting a target. Once his account reached 2 million, he would commit 10% of his annual profits to scholarships for underrepresented finance students. When he finally hit that milestone, his trading lit up with a new sense of energy. Every profitable year carried meaning that went beyond his own balance sheet. Neuroscience shows why this shift matters. Purpose activates the brain's ventromedial prefrontal cortex, the same area that integrates personal values with decision-making. When purpose is present, stress responses dampen, resilience rises, and setbacks lose some of their sting. In trading terms, purpose stabilizes psychology, no matter whether you're on a winning streak or brutal drawdown. That shift doesn't always require philanthropy or million-dollar milestone. Nina began by posting daily market breakdowns on social media, free for anyone to read. At first, it was just a creative outlet, but over time, her posts built a community, and she realized she felt more energized by messages from traders she'd helped than by her own winning trades. What started as a side habit turned into the most meaningful part of her career. The earlier you define what your trading stands for beyond the P/L, the more it compounds. Impact works like capital. One person you help today may help 10 more tomorrow, and the effect multiplies far beyond you. So the real question becomes this: if you quit trading tomorrow, what trades would you leave behind, and would you be satisfied with it? Because in the end, the charts, the numbers, the accounts, they fade. What lasts is the meaning you attach to them and the impact that outlives the trades themselves. Chapter 13. The Identity Unravel, when who you are is who you trade. When Peter introduced himself at parties, he didn't say he worked in finance or that he ran his own business. He said, "I'm a trader." It wasn't just his job, it was him. And when a brutal 6-month drawdown hit, it wasn't just his account that took the loss. It was his entire sense of self. That's the fragility of a single-thread identity. Full-time trading often grows into more than a career. It becomes the lens through which you see yourself. When things are going well, that fusion feels like confidence. But when the equity curve dips, your self-esteem can spiral with it. Elise learned this after 5 straight years of profit. A sudden market shift knocked her off balance, and she lost 20% of her account in 4 months. The money hurt, but the real damage was internal. She began doubting her worth as a person. She avoided friends, stopped posting in trader forums, even resisted journaling because she couldn't face the idea of putting her struggles into words. Psychologists call this role engulfment, when one role dominates your identity so fully that any threat to it feels like a threat to your entire existence. A 2013 study in Self and Identity found that people with a single dominant role experience sharper emotional swings when that role is challenged. For traders, that means every drawdown is not just financial pressure, it's existential. John fell into this trap during a bad crypto cycle. After losing 30% of his account, he didn't pause or reset. He doubled down, trying to prove he was still the trader he believed himself to be. But his trades weren't born of confidence. They were born of fear. The harder he tried to force wins, the deeper the hole became. This is the identity performance feedback loop. Your wins feed your sense of self shapes your confidence shapes your trades, and your trades feed back into your wins or your losses. When identity and performance are fused too tightly, it's a fragile cycle. One break in the chain can unravel the whole thing. Maria found another way. She realized she'd built too much of her self-worth on trading alone. So she deliberately grew new roles for herself: mentor, investor, volunteer. When her trading flattened for a year, her mood didn't collapse with it because she had other anchors to hold her steady. Neuroscience helps explain why this matters. The brain's default mode network, the system tied to self-reflection, goes into overdrive when identity feels threatened. That overactivation drives rumination, obsessive self-monitoring, and even paralysis. It's why traders in identity crisis spend more time thinking about trading than actually trading effectively. Peter eventually recognized this himself. After his devastating year, he stepped away for 3 months. He traveled, reconnected with friends, explored hobbies that had nothing to do with markets. When he returned, he still introduced himself as a trader, but it wasn't the only thing he said anymore. Trading had gone from being his entire self to being one part of a broader identity. That shift didn't weaken him as a trader. It made him more resilient. And maybe that's the real question. If trading vanished from your life tomorrow, what would still make you feel valuable? Because if the only answer you have is your last trade, then your identity isn't built, it's borrowed. And borrowed things can always be taken away. Chapter 14. The Burnout Debt. How traders trade away their energy without knowing it. When Daniel started trading full-time, he thought burnout was something that happened to corporate employees, not independent traders. He was doing what he loved. After all, he controlled his own schedule. He could take breaks whenever he wanted. Yet, 2 years in, he woke up exhausted most mornings, felt emotionally flat, and dreaded opening his charts. That's the hidden nature of burnout debt. It doesn't strike suddenly. It creeps. Like financial debt, it builds gradually, disguised by the illusion that you can pay it off later. For traders, the payments come in mental fatigue from decision overload, emotional wear from constant swings in P, L, and physical neglect from hours of sitting at screens. In the beginning, you don't notice it, because the wins mask the slow drain. Leah learned this the hard way. She loved trading news catalysts, the adrenaline was addictive, but that excitement kept her glued to her desk, 12 hours a day, 7 days a week, just in case something happened. Her performance didn't collapse because she forgot how to trade. It collapsed because she was operating on a permanent energy deficit. The same thing happened to Marcus, who convinced himself that taking a day off was weakness. He pushed himself to trade every single session, terrified of missing opportunities, until his decision-making fell apart. His win rate dropped double digits in a single quarter, not because the market changed, but because his mind was cooked. Burnout hides behind the illusion of productivity. More hours, more charts, more effort, but the longer you grind, the faster the mental edge dulls. Neuroscience explains why. The prefrontal cortex, the part of the brain that manages judgment, risk, and discipline, burns energy quickly. Under heavy load, its performance falls. That's why late session trades, after a long day of forcing focus, are more likely to be impulsive, oversized, and rule-breaking. Sasha nearly went down that road until she caught herself slipping. She rebuilt her process around recovery as deliberately as she had once built her trading system. 90 minutes of focused screen time, 30 minutes away, one full hard reset day per week with no market contact. Within 2 months, her energy rebounded and her net profit per trade rose noticeably. She hadn't changed her edge, she simply stopped over-leveraging her brain. Ethan took it a step further. He realized he always burned out during high volatility months. So he adopted what he called a surge and coast model. Push harder when the market demanded it, then pull back intentionally once the storm passed. By syncing his effort with the rhythm of the market instead of trying to run at full throttle year-round, he protected his longevity. That's the mindset shift most traders miss. Burnout isn't proof of dedication, and it's not a badge of honor. It's a signal that you've been mismanaging your most important capital, your ability to think clearly. You'd never over-leverage your account. So why over-leverage your mind? And maybe that's the real test. If your mental energy were an account, would you be compounding it or bleeding it dry? Chapter 15. The Exit Illusion. Why walking away from full-time trading feels impossible. When Liam's account dropped below half of its peak, he knew something was wrong. He wasn't enjoying the process anymore. His strategies no longer fit the market. Emotionally, he was drained. But instead of walking away, he logged in every morning with the same thought: I'll just trade until I make it back. Most full-time traders tie their exit to some symbolic milestone, a return to peak equity, one last big win, or the hope that their confidence will magically return. This anchor turns into a sunk cost trap, where leaving feels like locking in defeat. Instead of making a strategic decision, traders keep chasing closure in a game that no longer serves them. Claire fell into this exact cycle. She'd promised herself she'd retire from trading by 50. She actually hit her financial target 2 years early, but when the moment came, she couldn't do it. Without trading, she feared she'd lose her identity, her daily structure, her very purpose. So she kept at it part-time, telling herself she was easing out. 3 years later, a brutal quarter wiped out the extra she'd earned, and the graceful exit she wanted was gone. This is what I call the exit illusion. The belief that leaving full-time trading must happen either in a blaze of glory or in the ashes of burnout. It ignores the middle path, stepping away while you are still in control. Rob managed to find that middle ground. When he realized he was trading only to avoid the discomfort of stopping, he created a 6-month exit plan. He cut his position size in half, transitioned to part-time consulting, and sold off his riskiest positions. By the end, he didn't walk away bitter or broken. He walked away on his own terms, with the freedom to return whenever he chose. The resistance to exit runs deeper than money. Neuroscience shows why. The brain is wired with loss aversion. We feel losses twice as strongly as equivalent gains. So stepping away, even rationally, feels like failure. A study in the Journal of Behavioral Decision-Making found that people delay quitting losing endeavors not because of the activity itself, but because their brain interprets the exit as a permanent loss of identity. For traders, this means that giving up the screens isn't just leaving a job, it feels like leaving yourself behind. But it doesn't have to. Samantha reframed her trading career as a season of life, intense, meaningful, but not forever. That mindset freed her to exit while still winning. She took her profits, invested them, and pivoted into building a trading education business. She never felt like she quit. She simply moved to the next chapter. The truth is, there are always signals that it's time to step back. When you're chronically burned out and never recover, when your strategies stop working and no amount of adaptation helps, when your lifestyle values shift and trading no longer matches them. when wins and losses blur into the same dull emotional flatline, or when opportunity costs spike and you realize your time could create more value elsewhere. The signals are there, but the illusion keeps traders from listening. Breaking free requires redefining what success looks like. It's not about living at peak equity. It's about living in alignment with your life. The strongest exits are planned like trades. You set a benchmark in advance, you map the transition financially and emotionally, you diversify your identity and your income before you go, and you step out in stages rather than all at once. And perhaps most importantly, you frame it as a pivot, not an ending. Because walking away from full-time doesn't erase your past, it simply reallocates your energy toward what matters next. Michael proved that to himself. He sold most of his trading positions, moved his capital into dividend investments, and kept a small account for what he called fun trades. Without the pressure of daily performance, he rediscovered joy. He didn't stop being a trader, he stopped letting trading define the terms of his life. Maybe that's the real test. If you knew you could always come back, what would make you choose to exit full-time today? Full-time trading isn't just a career, it's a chapter. And knowing when and how to close that chapter is what separates those who burn out from those who move on in strength. Climax. The moment of truth. At the start of this journey, we looked at traders who believed full-time trading would be the thing that saved them. From dead-end jobs, from financial ceilings, from lives that felt too small, and in many ways, it did. Trading has a way of breaking walls you didn't even know were there. But the truth every full-time trader eventually learns is this: the very thing that saves you can also destroy you unless you master it. And more importantly, master yourself. Rachel reached 7 figures and felt empty. Liam couldn't walk away even when the game stopped serving him. Peter built his entire identity around trading and watched it unravel in a single drawdown. These weren't failures of skill or edge or discipline. They were failures of self-awareness, blind spots in the inner game. Because trading doesn't just test your entries and exits. It tests your patience, your adaptability, your ability to manage energy, protect relationships, and define yourself as more than a PL. Some traders ignore those tests. They grind harder, stay longer, push more until the count is gone or the fire is. Others, the ones who last, treat their energy like capital, their relationships like assets, and their identity like a diversified portfolio. They understand the real goal isn't to survive the market. It's to leave the market each day with more than you started. Not just more money, but more clarity, more resilience, more of the life you actually wanted when you began. That's the paradox of trading. It doesn't give you freedom. It gives you responsibility, the responsibility to design a life worth living while you chase the edge. Freedom without design is just another cage. So if you're here, in the thick of it, staring at the charts, feeling the weight of it all, ask yourself, is the way I trade building the life I actually want to keep? Because in the end, it won't be your PL that defines your career. It'll be the way trading changed you and whether that change was worth it. When you started this video, you might have been looking for the secret to making full-time trading work forever. And maybe you've realized there's no single tactic, no magic setup, no perfect schedule that protects you from the deeper battles. Because full-time trading isn't just about your strategy, it's about your psychology, your energy, your relationships, your sense of self. We've seen how the market can rescue you from a life you don't want, but also how it can quietly pull you into one you didn't choose. The invisible relationship tax, the adaptation gap, the independence illusion, the burnout debt, the exit illusion. These aren't just risks to your account, they're risks to your life. If there's one takeaway, it's this: full-time trading gives you the power to design your days, but you still have to design your life. Protect the things that matter when the screens are off. Build systems that keep your edge sharp without dulling your spirit. And remember, you can be a phenomenal trader and a fulfilled human. Those are not mutually exclusive. So here's your challenge. Drop a comment and tell me the one change you'll make this week to keep trading from taking more than it gives. And if this hit you hard, hit the like button so more traders see it. Subscribe if you want the deep dives. Other channels won't touch the ones about the real battles inside your head, not just the ones on your charts. And if you know someone who's in the grind right now, send them this video. It might be the perspective shift that saved their career. Trading will test you, but if you master the trader you bring to the market, you won't just survive, you build a life worth fighting for. I will see you in the next one.